Hi everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, February 28th, 2026. Hey, how you doing? I appreciate you coming to my weekend review podcast. I hope you're doing well, and I hope you had a good trading week last week. So the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions and all the trades that I made last week. We are going to talk about when I entered the position, why I entered the position, what the setup was, what the confluence of signals were, how I position size correctly based upon the current market volatility, how I place my emergency stop, how I place my end of day stop, how and what I do when I get to trailing stop level, how I take partial profits if the market goes my way, and then if we get to extreme levels, how I exit the positions. I had a good trading week last week. I hope you did as well, but we're going to take a look at all the positions, the current open positions that I have, and then some of the positions that I exited, either hit my stops or got to extreme levels or hit my upside stops to where I exited. So I hope this is going to be helpful for you. Hope it's going to give you an idea of how I look at trading and how I manage trades. After that, we are going to talk a little bit about trader psychology. Always, it's the biggest part of trading. It's the biggest skill in trading is the ability to create a plan and then follow the plan. Sounds easy, but it's not. There are a lot of good trading methodologies, trading processes, but you can have the best one in the world, but if you don't follow it, what good is it, right? So I always like to talk about trader psychology, add a little bit to the podcast, helpful for me to teach, and hopefully it'll be helpful for you to listen to. After that, I have gone down through my master watch list. I go through that every Friday night, and I look for potential trades for the next week. Now, I have 11 of them here on the daily time frame that we'll go through later in the podcast. But they are not where they need to be, but they're within striking distance of being at some pretty key levels. And key levels for the way that I look at trading are order blocks, major moving averages, RSI levels, MACD divergences, V1s, V2s. These are the signals that I look for. I look for rejections of these signals, and then I get in, place my stops, and if it works, great. If it doesn't, great, right? We take losses all the time, but the key thing about trading is having a good risk to reward ratio so that if you're wrong more times than not, you can be wrong small. But if you're right, you may have the potential for a large upside gain. So I will go through what I'm looking for next week. I think we're getting close to some good entries on some interesting stock symbols. And so we'll go through there and I'll show you what I'm looking for and what I'm looking to potentially get into next week. So like I said, I hope this is going to be helpful for you. If it is, I would appreciate if you could hit the thumbs up button. Really helps to build the channel, lets YouTube know there's some valuable content so they can get it out and share it with more traders. So let's get this U.S. legal disclaimer out of the way and then we'll get started. So hang tight, please. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. So let's start with the Google, G-O-O-G-L. I did enter Google on the 17th of February at 302.01, $302.01. And the question is, why did I enter it? Well, two reasons. I always like to look for confluences in my setups, or in other words, I like to look for more than one entry signal. And this particular entry signal, there were two primary entry signals. The first thing that I'm going to point out here is this green box. This green box is called an order block, or like I like to call it, a smart money area. So let me first explain to you why this is an order block. Now, people trade order blocks several different ways. What I am going to be showing you is the way that I use them. It's very successful for me. I've had really great results for many, many years using it this way. Some people do it a different way, but I try to simplify it because I think simple is always best. So the way that I look at it, first of all, to have an order block, what I need first is I need what is called a swing low. A swing low is simply a bar that has a higher low to the left and a higher low to the right. So these three bars here would be what is called a swing low. Higher low to the left, higher low to the right. So I start off looking for a swing low. After the swing low, I need what is called a swing high. Swing high is just the opposite. This is a swing high here because it has a lower high to the left and a lower high to the right. Okay, so first thing we need is a swing low. Second thing we need is a swing high. The third requirement is we need another swing low in the future that is lower than the first swing low. And you can see this is a swing low because it has a higher low to the left and a higher low to the right. So we have the three that we need. We have a swing low, we have a swing high, we have a lower swing low. Now, when that is in place, the important key event that has to happen is that after you have a swing low, you have a swing high, you have a lower swing low, you have to, in the future, go above that first swing high. So swing low, swing high, lower swing low. And you can see here on the 2nd of January, we did go above that first swing high. So when you have a swing low, swing high, lower swing low, and then you go above the first swing high, you have what is called a market structure change. We have now changed market structure to the upside. And you can see once that happened, it did take off and it did go. But I don't buy the breakouts. I'm not a breakout buyer. I am looking for a structure change to the upside, which happened here. And as soon as this happens, as soon as we take out that first swing high, now I can identify my order block or my smart money area. And that is the lowest closing bar. You can see this bar is the lowest closing bar prior or before the market structure change. So swing low, swing high, lower swing low, market structure change. As soon as this day happened here, I know this is my order block. Now, how do I use the order block? Like I said, I don't buy the breakouts. I wait after the breakout happens and changes market structure to the upside, to the bullish side. I am waiting for pullbacks back into that smart money. So let's take this to an extreme. If we go here on February 3rd at the high and we look back at that order block, is it fair to say when price is up here and we look back here that smart money was buying at this area? Well, clearly it was because it's way up here. People that bought back here did very well. So the order block is the smart money area. Now, I am waiting for the market to come back to that smart money area. Now, clearly this was smart money here when the order block, when we've defined the order block. Doesn't mean that it's going to be smart money again in the future if it comes back to that area. And the answer is no. 100% it does not have to be smart money again. Things can change in the world. Things can change in the company. But more times than not, over my 30-year career as a trader, more times than not, when it gets back to that original smart money area, it's smart money again. And more often than not, that particular market will bounce at that point. So that therein lies the edge in using the order blocks. So I mentioned that I like to have multiple signals, and there's several different ways that you can take entries in the order blocks. You can take a rejection of the high of the order block. You can take a rejection of the low of the order block, or you can take a rejection of another indicator inside the order block. That could be a major moving average, that could be an RSI level, that could be a level, another level that I might discretionarily put in. But So we have our swing low, we have our swing high, we have our lower swing low. We break market structure to the upside, defining the smart money area. We bring the smart money area into the future, and we wait. And I wait. I wait for the price to come back into that smart money area. Okay, that happened. So I entered here on the 17th of February at $302.01. Why? Well, for one, it was in the order block, was in the smart money area. But this is where the combination of signals happens. On this particular day that I took it, we went under the 30 RSI during the day, and then we closed back above the 30 RSI at the end of the day. That is a different system. That's a different signal. That is called a deep dip buy signal, when you intraday go under the 30 RSI and close back over the 30 RSI. So that was my signal. That's why I took the trade. So let's talk about position sizing, because it is really the most important part of trading ultimately when you are trading, is how many shares are you buying of this particular market. So let me show you the formula that I use, and it's very important. As a matter of fact, last night I had a conference call with a quant fund. They do high frequency trading, and I was listening to their presentation and talking with their coders. And one of my main questions for them was, how are you adjusting for volatility? Right? It's super important. And even a lot of professional traders don't do this, but if the market is more volatile, you need to buy fewer shares. If the market's less volatile, you can buy more shares. So let me show you. It's a very simple formula that I use that takes all this into account. So, all right, so I come down here, I have my intraday rejection of the 30 RSI in the smart money area. Say, okay, I'm going to buy this. Okay, two pieces of information I need to make the correct decision on how many shares to buy for the way that I trade. The first is, how much do I have in my trading account? Very simple. So let's just say I have $100,000 in my trading account. What I do is I just take the standard 1% of whatever I have in my account. So 1% of $100,000 is $1,000. If you have $200,000, 1% is 2,000. If it's a million, it's 10,000, so forth, right? So $100,000 times 1% is $1,000. Now, I take that $1,000 or whatever that number is, 1%, and I look for the value of the 2 ATR. ATR means average true range. That is how much this particular market is expected to move on any particular day. Well, I take that value and times it by 2, okay? If the average true ranges are larger, that means volatility is higher. If they're smaller, it means volatility is smaller. So taking the value of the 2 ATR, dividing it into my maximum allowed loss, tells me how many shares to buy. And so the 2 ATR is really telling me how much volatility there is in the market. So $1,000 divided by 1993, there you go, 50 shares. That tells me, based upon the volatility of the market and how much money I have in my trading account, for me, this is the correct amount of shares to buy. All right, so 50 shares. So I have the rejection of the 30 RSI inside the order block. I buy 50 shares at 302.01. Now, the next step that I take is immediately after entering whatever the 2 ATR value was, I subtract that from my entry price. So 302.01 minus the 2 ATR, I place my emergency stop below my entry price. Now, we just did the math. So if I have 50 shares and it hits my emergency stop, how much have I lost? We did the math. I would lose $1,000. $1,000 is 1% of my account. Now, it's never fun to lose 1% of your account, but you can recover from 1% of your account. If you get down 20%, 30%, a lot harder to recover. But in a trade, you have to have your uncle point. You have to have the worst case scenario. So the worst case scenario for me is going to be a 1% of my account, and therefore I place my emergency stop 2 ATRs below. Now, the good news is this only happens about 5% of the time that you'll hit your emergency stop. I hit one this week. It does happen, and I'll show you that. as we go through more positions. But I always use two stops. I use an emergency stop for the worst case scenario, and I use an end of bar stop that's going to be much closer to my entry point than the emergency stop. I took this trade because during the day it went under 30, over 30. So my end of bar stop on this trade will be in the future if it closes back under 30. And when I got into this trade, it was barely over 30 to begin with. So it gives me a very good risk to reward. So if the next day even goes down a little, I'm out. So 95% of the time, if I take a loss, it's going to be because of my end of bar stop got hit compared to my emergency stop only 5% of the time. And that's the key in trading. Good risk to reward ratios. If you're wrong, more times than not being wrong small. And so that is how I structure my trade. Okay, next thing. After I see the trade, after I position size, after I place my emergency stop 2 ATRs below, and after I know what my end of bar stop is on this, it's just a close back below the 30 RSI, I look to the 1.5 ATR. Right now, that is $14.94. All I do with that is once I place the trade, I look whatever the value is of the 1.5, I take my entry price and I place the 1.5 ATR, whatever that value is, above my entry. And this is my trailing stop level. And so, in trading, once you enter a trade and it starts going in your direction a certain amount, in my case, 1.5 ATRs, well, once you start having a decent move in the trade, you don't want to give it all back, right? You want to tighten up your stop. That's just, you've heard this, I'm sure, many, many times. Well, my trailing stop level, that's what it accomplishes. If in the future, I get to my trailing stop level, now I have a rule that comes into play that tells me in the future now, because I've hit that 1.5 ATR threshold, in the future, if it keeps going up, fantastic. But if in the future I have a close below a previous bar's low, I'm going to exit half the position. And by exiting half of the position, that has the effect of moving everything up, moving all my stops up. All right, so I hope that makes sense. So everything I have talked about so far as your emergency stop, your end of bar stop, going into trailing stop level 1.5 ATRs above, these are all defensive maneuvers. So in other words, if the market starts going against me, I'm going to, for whatever reason, I am going to have to take action, defensive action. But in trading, just like in sports, I like to play offense in my trading, not just defense, right? And the way that I do that is if the market moves in my direction a certain amount each day, I am going to play offense and sell into that strength, right? And let me show you exactly how I do it. It's very easy. So I'm in Google right now. Let me show you exactly how I'm going to do this for Monday. I redo this every single day. I mean, it takes work, right? But I'm telling you, it's worth it for these partial profits. So what I do is I look at the closing price of the day. Right now, Google's closing price is $311.69. I simply take the closing price of the day, and now I look for the value of the 0.45 ATR. The value of the 0.45 ATR is $4.48. I just add them together. Closing price plus the value of the 0.45 ATR is, add the 4.48. My first profit target for Monday is 316. What was that? 17, right? 316.17. So I always put a little line here, 316.17. That is my first profit target for Monday. Now, I always place 3 profit targets every day. I showed you how to get the first profit target, closing price plus the value of the 0.45 ATR. First profit target, 316. To get my second profit target, I take the first profit target, which is 316.17, and I just add the value of the 0.45 to it again. 316.17 plus 4.48. My second profit target for Monday is 320.65. So I'll put a line there, 320. 65. Perfect. Now I have 2 profit targets. Every day I place 3. So I have my second profit target. How do I get my third? Simple. Take my second profit target, add the value of the 0.45 to it again, plus 4.48. My third profit target for Monday only is 325.13. Okay, so I have my 3 profit targets for Monday. Now, how do I use these? It's very simple. I take 10% off however many shares I have going into that day at each profit target. So if I go into the if I have 50 shares of Google at the moment, I'm going to place 3 limit orders in my system for Monday. 10%. 10% of 50 is 5. 5 shares here at 316.17. 5 shares here at 320.65. 5 shares here at 325.13. If it goes down, I'm obviously not going to hit any of them, right? And I'll have to redo it the next day for the next day's close. But if it does move up decently, maybe I hit 1 profit target. If I have 50 shares, I take off 5 shares. If I have a really good day, I hit 2 profit targets. If I have a super good day, I hit 3 profit targets. There are days where I have hit 7 or 8 profit targets, and I'll show you some examples of those. But I love selling into strength. I love selling something, not everything, just a portion into strength. And a lot of times, if you take a trade and it starts moving up great and then it comes back down, you are really glad that you took some profits when you had them, and they add up over time. Trust me. Okay, so now I've kind of gone over the basics. Let's do a real quick recap. And going forward, I won't spend as much time on this because I've explained it on here on Google. But now let's take a look at the trade as a whole. Okay, I entered here 17th of February at 302.01. Why? Well, we have a bullish order block. On this particular day, we had another entry signal, which is the intraday rejection of the 30 RSI. I entered 302.01. I position size based upon the volatility. I placed my emergency stop 2 ATRs below. My end of bar stop is very close, simply a close back below the 30 RSI. I placed my trailing stop level 1.5 ATRs above, and away we go. Next day goes up a little, not even enough to hit a profit target, but it did stay above the 30 RSI, so I stayed in the trade. The next day, again, kind of a nothing burger. Didn't do anything. Didn't go up to hit any profit targets, but it closed above the 30 RSI, so I stayed in the trade. The next day, great day. I hit multiple profit targets into that strength, right? I think I hit 2 profit targets on that day. So great. I reduce my position size. I lock in some profits. I have fewer shares. There's less pressure. There's a lot to be said about having fewer shares every day as it goes up, because the fewer shares you have, the more likely you are to follow your process. The next day, it gaps open. I took a profit target right at the open, and also on this day, we got to the trailing stop level threshold, the 1.5. Now, just because we're there doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. Okay, next day goes down, no profit targets, but it did not close below the previous bar's low, so I stay in the trade. Next day up a little, not enough for a profit target, but I'm still fully in the trade. The next day, which was Thursday, we have our first close below previous bar's low after reaching trailing stop level. What do? I take off half of the position, and I locked in a gain of 1.91%. Okay, now Friday we were up. I hit a profit target into that strength, right? And so going forward now, if we continue to move up, I showed you the 3 profit targets I have for Monday. If the market goes up on Monday, good. I'll sell it into some of those strength, right? However, going forward, if we close back below the 30 RSI, I'm going to have to get out. And if that were to happen, you can see the value that I took some shares off when I had the chance, and then I had the close below the previous bar's low after reaching trailing stop level. I'll be really glad that I sold half there, right? So, all right, so I locked in on half, 1.91%, and the remaining shares that I have on this swing trade on Google up 3.19%. All right, so that's Google. Let's go to Palantir. PLTR. Okay, I entered Palantir back here on the 5th of February at $129.62. What was the reason that I got into this trade? The reason that I got into the trade on Palantir was that we rejected the bottom of the order block. During the day, we went below the order block and then we closed back in the order block. That's rejection of the bottom of the order block. So I position sized here, got in at 129.62. I position sized based upon volatility as always. I place my emergency stop 2 ATRs below, as always. Remember, if it does go down there, how much will I lose in my account? 1%. My end bar stop is simply a close below this green box. And look how close we are to it already. So if I'm wrong, I have the potential to be wrong very, very small, right? I placed my emergencies after I entered. I placed my trailing stop level 1.5 ATRs above. And now I know exactly what I'm going to do regardless of what the market does. And it's extremely important, everybody, that you have a plan. You know exactly what you're going to do. You're never caught on your back foot like you don't know what you're going to do. You have if-then statements. If this happens, I'm going to do that. If that happens, I am going to do this. And it's hugely important that you do that. So, all right, again, I entered rejection. Bottom of the order block, 129.62. The next day, it does go up. What do? I took a partial profit, reduced my position size. The next day, up again. Really nice up day where I hit multiple profit targets. On this day, I also got to trailing stop level. Okay, doesn't mean I do anything. It just means now in the future, if I have a close below previous bar's low, I'm going to get out of half. The next day, gaps open a little bit, not enough for a profit target. And then the next day, we have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the remaining shares that I have. And I did that for a gain of 4.61%. Now, the next day we go down. During the day, we were under the order block. Had it closed there, I would have had to gotten out of the trade. But it closed back in, kept me in the trade. Next day, moved up, profit target. Next day, again, tested the area below the order block, but closed back above. Kept me in the trade. And this is a good time to mention, look, for me, at least, the closing price of the day is the most important part of the day. And the reason why is that large financial institutions, they make their moves at the end of the day. They have the best, they have the smartest people, they have the best information, they're dealing with the most money, they have the best technology, they're in the know. And by following what they do at the end of the day gives me more confidence that I'm buying the most valid price of the day, which is the closing price. So that's why I base everything on the closing price. Okay, but you can see 2 days in a row, we were underneath the order block, but it closed back in. That kept me in. Next day, we gapped up and went up. I sold some into that strength with a intraday profit target. And then for the next few days, we head down, head down, head down. Again, we went under the order block, closed back in it. The next day, look, it barely closed in the order block. It barely kept me in the trade. Had it closed below, I would have gotten out, but it closed in, so I stayed in the trade. Good thing I did, and a good thing it did, because the next day went up nicely, and I sold some shares into that strength. Next day went up a little bit, not enough for a profit target. And then Friday it went up a little bit, but not enough for a profit target. So the remaining shares that I have on PLTR currently up 5.49%. Going forward, if Monday it goes down and closes below the order block, what am I going to do? Just going to get out of the trade, and I'm going to be thankful that I sold into the strength while I had it. If it continues up, I'll continue to take partial profits every day with my 0.45 ATRs. Now, in the future, if this were to go up significantly and get above a 65 RSI level, then I have other rules that come into play. Specifically, if I get above a 65 RSI level and then it closes below the 5 EMA, I'm going to be out of the trade. Alternatively, If we go up and reject the 70 RSI level, then I'm going to exit half of the remaining shares that I have. And then if it rejects the 75 RSI level or the 75 RSI level and I sell half, then in the future, if I have a close below previous bar's low, I'm completely out of the trade. Those are the rules. Those are the rules I've been using for 30 years, and they really work. But we're not there yet. We're just going to have to see what happens. But again, I have a plan regardless of what it does. I know what I'm going to do, and it's a good feeling. And I would suggest that you get yourself a process where you know exactly what you're going to do at all times. But again, the remaining shares that I have on PLTR up 5.49%. Okay, ARK. ARK, you can see we have the green box. This is the order block on the 12th of February. During the day, we went below the order block. We closed back in the order block. That was my signal. I entered 68.41. Position size, I placed my emergency stop 2 ATRs below. I placed my trailing stop level 1.5 ATRs above. Next day, goes up. Great. Good start to the trade. Hit a profit target. Next day, nothing. Next day, up again. I did take a profit target into that strength, and I also got to trailing stop mode. Okay. Next couple days, sideways motion, didn't do anything. The next day, we have a close below a previous bar's low after reaching trailing stop level. What do? I take off half the shares. And I did take off half the shares for a gain of 2.29%. Next day, great. Moves my way. I sell into that strength profit target. Next day, up again, profit target. Next day, up again, profit target. And then Friday was down. So the remaining remaining shares I have on ARKK, currently up 6.13%. But let me take you back to the entry. Look at my risk to reward. My end of bar stop was so close to my entry, and that's the key. The next day, had it closed below the order block, even by a penny, what would I have done? I would have gotten out with a small loss. I can always get back in. But that's the key in trading, having an initial good risk to reward, taking partial profits into the strength, and then having a rule-based system that tells you exactly what to do. So being up 6.13% on a very small initial risk to reward ratio is pretty good. Netflix. Okay, this was a monster trade, and a lot of my students are in Netflix, so congratulations, guys. This was a really great trade for us. And let's go back to where we entered this trade. So I entered this trade back here on the 18th of February at $77.94. Okay, what was the signal, or what were the signals? The signals were two signals. The first signal is the previous day we were under the 30 RSI, and the next day we closed back above. That's a deep dip by signal. That's one signal, okay? The other signal was the trend line, the megaphone trend line. The megaphone trend line is when you have a swing low, and then in the future you have another swing low that's lower than the first swing low, and you connect the bottoms, and then the slope of that line in the future. So we've had two touches, 1, 2. The third touch, more times than not, there's a bounce, and that tends to be a good entry point. I'm not going to buy something just because it rejected the trend line by itself. Well, I would if it was in an order block, but this didn't have an order block. But those were the confluence of signals. The previous day we were under the trend line. The next day we closed over the trend line. And in addition to that, like I said, the previous day we were under the 30 RSI. The next day we closed over 30 RSI. Okay, so I entered here 77.94. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI and or a close below the megaphone trend line. I placed my 1.5 ATR trailing stop level above, and away we go. Next day, it went down, but it held the trend line and it held the 30 RSI, so it kept me in the trade. The next day, it went up a little where I hit a profit target. Next day down, But again, it did not close below the trend line and it did not close below the 30 RSI. Next day up, great, profit target, and then it started its move. Next day up huge, right? Multiple profit targets. And I'm at trailing stop level, okay? So now I'm in trailing stop mode. Next day up again, multiple profit targets. I sold into that strength, and then Friday we were up 13.76%. I think I hit 6 profit targets on this day up. So I took advantage selling into that strength. Now, we are at a 71.59 RSI. Makes this trade extremely simple at this point. As long as Netflix stays above 70 RSI, I'm going to continue to stay in the trade and take partial profits if it continues to go up. However, if on Monday we close back under the 30 RSI, that's my signal to sell half of the remaining shares that I have. If that were to happen, the way that I'll get out of the entire rest of the trade is that in the future, if I have a close below previous bar's low, after rejecting the 70 RSI, I will be completely out of the trade. So this trade has been a monster. Congratulations to everyone that had Netflix that's in this. Up 19, the remaining shares I have up 19.01%. And again, let me take you back to the risk to reward ratio. I got in here, had the next day it closed even a little bit below, it would have got me out for a small loss. So starting with a good initial risk to reward is super important. So that if you're wrong, you can be wrong small. And if you're right, you have the potential for this to happen. And I'm very grateful that that happened. So the remaining shares up 19.01% on Netflix. VIX. Okay, I've been in this trade for a minute. I entered VIX here on the 15th of January at 26.29. Why? 2 reasons. First of all, we have an order block. Let's find the order block. Swing low, swing high, lower swing low, market structure change. As soon as the market structure change happened, I define the order block. Lowest closing bar before market structure change. So I bring that green box, the order block, into the future. Now, I don't have any moving averages inside this order block or 30 RSI levels, okay? Well, they're 30 RSI levels, but not the ones that I want. So there are times where I place my own level inside of the order block. And the level that I placed was 26.10. Why did I choose 26.10? It's based upon this bar here on the 13th of January. You see the large up bar we have here? So when you have large up bars, the tendency is if you have a retracement back to 50% of that big up bar, you will find inherent support. And it works the other way. If you have a big down bar and then you rally back to halfway of the big down bar, that is resistance. So that's why I drew the line here at 26.10. Big up bar, drew the line 26.10, also in a bullish order block. Okay, so I entered here 26.29 because it rejected that 26.10 level. My initial stop was a close back below that 26.10 level, which was very close. Next day goes up a little bit, and the next day, huge move up. I hit 7 profit targets into this move. In other words, I took 70% of my trade off into this huge move, which was great, right? Next day, and we got to trailing stop level clearly, way above it. So the next day we have our first close below previous bar's low after reaching trailing stop level. At this point, I don't have a lot of shares left, but I followed the rules and took half off, locked in a gain of 1.76%. Now, at this point, I have so few shares that my original stop here was 26.10, but I changed it because I had so few shares left because of this huge move up. I changed my stop to a close below the low of the order block. Okay, so I took off half here, closed below the previous bar's low after reaching trailing stop level. Next day goes down a little bit. Next day stays above, closes above the order block, keeps me in. Couple days sideways, move up, move up. Then we have another big move up here where I sold 10% of however many shares I went into the day with into that strength. Great. Every time it moves up, has a good day, I'm selling something. Then next day was up a little, next day was down significantly, but it still closed above the bottom of the order block. Next day, big move up, sold into that strength. Next day, big move up, sold into that strength. Next day, big move up, sold into that strength. And then we pull back, fine, keeps me in the trade. Here on the 21st, another big day up. What did I do? I sold into that strength. Next day up again, sold into that strength. Next day up again, sold into that strength. Down, kind of sideways motion. Here, nice big up day again, taking profits into the strength. And then down, Thursday, we were very high at one point during the day, sold into that strength. And then again on Friday, I'm selling into that strength. And again, I don't have a lot of shares left here, but I'm continuing to follow the process, and the remaining shares that I have on this particular trade doing very well, up 8.96%. So again, I got in rejection of the midpoint line that I drew inside the order block. If the next day it had just closed back below, I simply would have been out. Theoretically, hypothetically, for a very small loss. But the initial small risk to reward ratio that I had gave me huge benefits, because there's no limit to the upside, but there's a very defined limit to the downside. So the remaining shares here on VIX up 8.96%. Silver, all right. I'm going to take you into a different type of trade here. Normally, I take partial profits. I have the emergency stop, end of bar stop. This is true for all of my trading strategies, except for this particular one that I'm going to show you. I entered silver, SLV, here at $69.80. Why? Well, you can see this bar that I highlighted in the blue. This is what's called an abandoned baby. An abandoned baby is when the previous day gap, well, the abandoned baby day, the previous day we gapped down. You can see from this day to this day, we gapped down. So the market sentiment was very bearish at the open. However, the very next day, it gaps up. And this is very important, everybody. When you have a sudden shift in sentiment from bearish to bullish in a very short amount of period of time, there's a lot that's going on with that market going on under the hood when you have sudden shifts in sentiment from bearish to bullish. Well, that's what happened. We gapped down. The very next day, we gapped up. In addition to that, we also rejected the high of the order block, the green blocks, the smart money area. The previous day we closed in it, and then the next day we closed above it. So what does that mean? That means we rejected the high of the order block. So we have two signals. We have a rejection of the high of the order block, and we have an abandoned baby, bullish abandoned baby. So I entered here at $69.80. Now, with abandoned babies, they're such strong trades that I manage them a little differently. I place my emergency stop 2 ATRs below, and then I place a 4 ATR profit target above, and I let the trade go. I'm either going to hit the 2 ATR stop, in which case I'll lose 1% on my account, or I will hit the 4 ATR profit target, in which case I will make 2%. So so this trade, if I'm right, I'm going to make 2%. If I'm wrong, I'm going to lose 1%. That's called asymmetrical risk to reward. If I'm right, I'm going to make more than if I lose. So it's a set it and forget it trade. 2 ATR stop, 4 ATR profit target. One of those two eventually is going to hit for sure. But if I'm right, I'm going to make twice as much money as if I am wrong. Now, I just don't do this randomly, but I did this because of the abandoned baby. The abandoned baby is very, very strong. Doesn't work all the time, but in my experience, it works about 70%. So anyway, it's obviously off to a really good start. I'm not to my 4 ATR profit target yet, but this particular trade since entry is up 17.82%. Good trade. All right, IWM. IWM is the Russell 2000. You can see we have an order block here. Let's find the order block. Swing low, swing high, lower swing low, market structure change. As soon as you market structure change, I can define the order block. The order block's the lowest closing bar. It's this bar here on the 5th. The high and the low is the smart money area. I bring it into the future. Now, this is a pretty easy trade. You can see the 50-day moving average. Remember, on order blocks, I can get in with a rejection of the high of the order block, the low of the order block, or a rejection of a major moving average, RSI level, or a level that I place myself. Okay, and so I placed two levels here. First, I placed my discretionary level at 258. Why? That's the green line. Well, these three bars are called a V2. V2 consists of three bars, bar 1, 2, and 3. Bar 2 has to go below bar 1's low. Bar 3 has to close above bar 1's close. That happened, right? The key point on a V1 or a V2 is the midpoint of the second bar. There it is. That's why I drew the line there. And by the way, if you want to learn more about V1s or V2s, go to my YouTube channel. I have a really good video there that explains these in details. And I use V1s and V2s in so much of my trading, just like I'm showing you here, right? I placed a level. Now, we also have the gray line, which is the 50-day moving average, okay? If I have a rejection of one of these levels, I could potentially take the trade, and that's what I did. And so I entered here on the 23rd at $260.46. Look at the bottom of this, the day that I entered. Where did it stop exactly? Almost to the penny. I think it was 1 penny off. Halfway of the V2. There's a lot of inherent support there. It's pretty amazing, right? But I took the trade, yes, because that happened. Number one, yes, because that happened. But I also secondarily took the trade because it rejected the 50-day moving average, meaning it went below the 50 and closed above the 50. So I got in $260.46. I placed my emergency stop, as always, 2 ATRs below. My end bar stop is simply a close below this 50-day moving average. I placed my 1.5 ATR trailing stop level above, and away we go. Next day goes up, hit a profit target. Great, good start. Next day goes up a little bit. I don't think I hit a profit target on that day. Next day went up a little bit. I don't think I hit a profit target there either. So I'm not at trailing stop level yet, but I am still above the 50-day moving average. So not a lot's happened. I took one profit target. That's it, right? And if it goes crashing down on Monday, at least I took that profit target, locked in a little gain, and took some of the position off, which mitigates my loss, right? So we always need to look at mitigating. How can we mitigate loss in our trading? So this trade's not doing a lot. At the moment, it is up 0.36% on the remaining shares that I have. Disney. Okay, I took Disney here on the 24th of February at $105.96. Okay, this strategy is not an order block. It's not a major moving average. It's just called a higher low V2. And so let me bring your attention to this green line and this green line. Anywhere below this green line and above this green line is considered the value zone. Anywhere in here is considered the value zone. One of my favorite setups is called what is called a higher low V1 or V2. The rules are that first we need to close below the bottom of the value zone, which clearly we did. The second requirement is that we then close in to the value zone, which we did. The third requirement is that we have a pullback, and then we have a V1 or a V2. And again, this is a V2, consists of three bars: bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. So there is a higher low V2 in the value zone. The reason I call it a higher low V2 is because this low is higher than this low. So we need to close below the value zone. We need to move into the value zone. we need to pull back and then have a V1 or a V2 that closes in the value zone, and that low has to be higher than the previous low. Check, 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 marks all those boxes. Now, on a higher low V1 or V2 in the value zone, the stop is a close below halfway of the washout bar. The number 2 bar is the washout bar because it washes out or goes below bar 1. So 104 is my end of bar stop. So I entered here 105.96. Next day went down a little bit. Next day up a little bit. No profit targets. Disney was up on Friday, and look, during the day, look where it came back, look where it came down to before it bounced. Halfway of the washout bar, the V2. I see this all the time, not surprising to me whatsoever. So this trade is up a little. We'll just call it even at the moment. But going forward, if it continues up, I'll continue to take profit targets. If it gets to my trailing stop level, I'll go into trailing stop mode. If on Monday it closes below halfway the washout bar, 104, I'm simply out. If it crashes down and hits my emergency stop, what am I going to do? I'm going to get out, right? And I'll lose 1% of my account. So again, I know exactly what I'm doing on this trade at all times. And this particular trade, well, I guess we should try to be exact here. This trade's up 0.14%. UNH, also a higher low V2. Again, green lines are the value zone. We close below the value zone. We close into the value zone. We pull back and create a V2 that closes into the value zone. Bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. And again, the low of that V2 is higher than that previous low. So it is a higher low V2. I want to thank my student and friend Vivek for pointing this out. I would not have found this trade without him. And so he said, hey, Greg, it's a nice higher low V2 in UNH. I was like, oh, yeah, it is. I love higher low V1s and V2s. So thanks, Vivek. Appreciate you letting me know about that. So I got in on the 25th here at 286. I'm sorry. Yeah, 282.86. I position size. I placed my emergency stop 2 ATRs below my end of bar stop. Again, is a close below the washout bar, the V2. I placed my trailing stop level 1.5 ATRs above. The very next day, moved in my direction. I did hit some profit targets and one up here before it reversed. So I was glad that happened. And then on Friday was up again, and I did hit one profit target. So I've taken 2 profit targets at profitable levels on this trade so far. You can see we're very close to trailing stop level, but we are not there yet. So the remaining shares that I have on UNH are up 3.55%. Okay, so those are all the open positions that I have. Doing very, very well. Now, I did have some trades that I got out of last week as well, and let's take a look at those. Okay, so I got into Nike, higher low V2, right? Same thing. We closed below the value zone, we closed in the value zone, we pulled back and we created a V2. I got in 62.90. I placed my emergency stop 2 ATRs below my end of bar stop, closed below halfway the washout bar. I placed my 1.5 ATR trailing stop level above, and away we go. Next day, moved up. Took profit targets into that strength. Next day, moved up again. Hit more profit targets into that strength, also at trailing stop level. Now, the next day was very, very interesting because during the day, we skyrocketed up where I hit multiple profit targets. Very glad that I took them while I had them. Okay, but when we were on this day at the high, we were above the 65 RSI level. If I get to 65, remember, in the future, if I have a close below the 5 EMA, that's the end of the trade for me. So at the high, yes, we got to 65. So now that 5 EMA comes into play. And then the very next day, close below the 5 EMA. What did I have to do? I had to get out for a gain of 0.33%. But do you see the value in taking these partial profits while I have them? Yeah, the remaining shares, I made 0.33%, but I made a lot more on that trade because I took profit targets here, I took profit targets here, and I took multiple profit targets right here at the top. But it's a good example of whenever I get to 65 RSI level and then close below the 5 EMA, I'm going to get out. But it still ended up being a profitable trade even on the remaining shares that I got stopped out of with the close below the 5 EMA, up 0.33%. And just to note here, remember the halfway of the V2 is the support. Look on Friday. We came down to that level. I'm not in the trade, but I'm just pointing this out that during the day we went below it and then closed above the halfway of the V2. It's an important structural level, and I see that level defended and rejected multiple times. Okay, so lots of good trades that I've had, but I did have a stinker of a trade and I did hit my emergency stop. So it does happen. I took the trade on Mastercard here on the 20th of February at 522.26. Why? Nice trade. Rejection of the bottom of the order block, rejection of the trend line. Really good trade, really good setup. So I got in 526.26. My end of bar stops a close below the order block, and my emergency stop, as always, is 2 ATRs below. Look what happened. Boom. As soon as it got to my emergency stop, what did I have to do? I had to get out, right? That's my worst case scenario point. Clearly, I'm wrong on the trade. I position sized it correctly so that I was wrong, but I knew how much I was going to be wrong, and I did lose 1% of my account on that trade. Now, percentage-wise, this was down significantly. This was down 4.69%, but I didn't lose 4.69%, right? Because of the position sizing, I only lost 1%. And I got out, and what happened? It rallied right back. It happens, everybody, right? But had this gone down, and the next day it had gone down, and the next day it had gone down, how can I live with that, right? So I have to follow my rules. So, yep, this was a losing trade, loss of 4.69%, and I did hit my emergency stop. So you can see those emergency stops do get hit. Okay, now, everything I've shown you so far, the open positions that I've shown you and the closed positions have been daily time frames. But I also trade the weekly time frames. And so weekly time frames, I look at weekly charts. Every bar is a week. So I got into IGV here on the 6th of February at 82.46 at the end of the week when the bar closed. Really good setup. Rejection of the bottom of the order block and a rejection of the 200-week moving average with a very good risk to reward ratio. Perfect. I got in 82.46. I placed my emergency stop 2 ATRs below, my trailing stop level 1.5 ATRs above. The next week, it went up. And while it was at the high of its bar, I did hit a profit target. So at least I took something off at a profitable level and reduced my position size. The next week, look here, it closed below my stop. What did I have to do? I got out. Was it a big loss? No, it was not. And that is, ultimately by design. It was a loss of 2.01%. But I have to follow my rules. I cannot control anything other than my rules. But again, I got in with the rejection of the bottom of the order block and the 200-week moving average, kept it for 1 week, luckily hit one profit target, and then not this week, but the previous week, closed below. I had to get out of the trade. UUP. All right, I've been in UUP for quite a long time. If I'm ever in a trade for a long time, I promise you that I'm positive on the trade. If I'm in the trade very short amount of time, it means I got stopped out either with my emergency stop or my end of bar stop. That's proper trading, everybody. Staying in trades that are working for a long time is fine. Staying in trades that are not working for a long time is not fine. So I got into UUP all the way back here on July 11th at 26.31. It was a combination of a deep dip buy and a rejection of the order block. The deep dip buy You see the black line, that's the 200-week moving average. The previous week we closed below it. The week that I entered, it closed above it. Okay, that's one signal. In addition to that, the previous week we were in the order block. The next week we closed above it. So that two primary signals, deep dip buy signal, rejection of the 200 weekly moving average, and a rejection of the high of the order block. I got in 26.31. I placed my emergency stop 2 ATRs below. My end of bar stop simply closed below 200 week moving average. I placed my trailing stop level 1.5 ATRs above. Okay, here we go. Next week, good start. Went up, hit a profit target. Perfect. Next week, came back down during the week under the 200, but it closed back above, kept me in the trade, which I'm grateful because the next week was up big, hit multiple profit targets into that strength. Also got to trailing stop level. Next week down again, and it closed below the previous bar's low. What do? I take off half of the remaining shares that I have for a gain of 0.49%. Then we move sideways here for about a month. This bar here was very significant because during the week we were well below the 200-week moving average, but it reversed and closed back above the 200-week moving average, keeping me in the trade. Had this closed below, what would I have done? I would have gotten out, right? But it closed above, kept me in the trade. Next week up, sold into that strength. Next week down, next week up again nicely, sold into the strength with profit targets, a couple weeks sideways. Next week up, again, sold up here into the strength, couple weeks sideways. Next week up, again, sold into the strength. Then we moved down for about a month. Then we had a few weeks up where I did hit a profit target on this week. Then we moved down sharply, and again, we were below the 200 week. Had it closed here, I would have gotten out of the trade, but it closed above, kept me in the trade. Then we moved up and down, again, tested the 200 week. Next week up, took some profit targets. So I've been in this trade a long time, just following the rules, and the remaining shares that I have here on UUP are up 2.84%. Okay, I also took a trade on IBM on Friday, so yesterday. What was the trade? Well, we have an order block in the green, but we also had some other things that happened on this particular week. So let's start with the order block. You can see during the week, we were well below the bottom of the order block, but we closed back above the order block. So that is a rejection of the bottom of the order block. That is one primary signal. In addition to that, look at the RSI. The RSI is 34.51. During the week when we were significantly lower, it was under the 30 RSI. So it went under the 30 RSI, closed back over the 30 RSI as well. In addition to that, we rejected the 100-week moving average. This is the red line. So a lot of confluences, rejection of the bottom of the order block, rejection of the 30 RSI level, and a rejection of the 100-week moving average. Really good setup, lots of confluences. I entered at 238.91. Position size, of course, placed my emergency stop 2 ATRs below my end of bar stop, simply closed below that 100-week moving average. I'm pretty close to it already, right? Now, if it goes up, I'm going to sell into the strength. Next week, on Friday, if it closes under that red line, I'm simply out. If it goes crashing down and it's my emergency stop, fine. I know the worst case scenario. I'm going to lose 1% of my account. Not likely. If I have a loss, it's much more likely that I'm going to have a much smaller loss with the close below the 100-week moving average. So this trade, slightly up, not a lot, but let's try to be precise. It's up 0.67% already on the trade. So there you go, everybody. As you can see, a lot more winners than losers. And again, the trades that I've been the trades that I've been in for a long time, it's because they're doing well. Trades that did not work out well, like Mastercard, I got out immediately. Let your winners, be very patient with your winners and be very impatient with your losers, and you do much better in trading. And I hope that I showed you this here. So, but all in all, really, really great week. I'm very grateful for that. So before we move on to the trades that I'm looking for next week, let's spend a few minutes And let's talk about trader psychology. Most important skill in trading. And this particular post is from Trading Composure. You can follow him at Trading Composure over on X. Really good channel, and he posts a lot of good information over the years. And let's see what Trading Composure has to say. I really like this post, everybody. First rule of trading: wait for the right opportunity. This is hugely important for a retail trader, and one of the largest edges and advantages that a small retail trader has. They don't have to be in the market all the time. They can wait for the right opportunity. Every good trade starts with this: wait for the right opportunity. You hear me talk endlessly about confluences of signals happening. If nothing's happening, there's nothing to do. Be patient, wait for the correct signals. It will pay you a lot of dividends in the future. Your trading life's going to be much better. Number one, wait for the right opportunity. Number two, accept what the market gives. I mean, I kind of laugh because accept what the market gives. You're going to accept it one way or the other because you have no control over it, right? But emotionally, psychologically, be prepared to just accept and don't fight it, because if it's gonna give it to you or take it from you one way or the other. It's nothing you can do, but you have to be okay. Just be okay with what it gives you, right? Accept what the market gives. Number three, understand what you're risking. This is hugely important. I mentioned earlier in the podcast that the position sizing is the most important part of the trade, because if you're too big and the market hammers you, you are in deep trouble. If you're super small and the market hammers you, it's not fun, but it's not going to hurt you. So you have to find some place in the middle where it's significant if it moves your way, but it's not devastating if it moves against you. And that's why the rule that I told you, 1% of your account divided by the value of the 2 ATR, that's what I use, and I really like that. But you have to understand what you're risking. If my emergency stop's $1,000, I really better be okay with $1,000 loss. And if you're really not okay with it, make that loss 500, make it 200. But you really have to understand ultimately what you are risking. Number four, accept what the market takes, right? We have to accept what it gives. We have to accept what it takes. You just have to be okay with it. And that's really the key. You have to find the right gains and losses that you're okay with. If you want to trade for the rest of your life, you got to find the right number, because if it's too high, it's going to wear you out. It's going to stress you out. Really, we don't talk a lot about it or enough about it, in my opinion, but you have to dial it in. You have to find the right number that you're good with that lets it be sustainable, because you are going to have gains and you are going to have losses. Number five, make your trading process your whole world. This is so important right here. If find yourself a trading process, whether you find it from me, whether you learn it from me or someone else, it doesn't matter. Find a trading process that you're comfortable with. Find the right number that you're comfortable with so that it's sustainable and a process that has an edge. There's an old saying, do more of what works. Whether you're a breakout buyer or a dip buyer or a regression buyer or moving average crossover buyer, they're all legitimate, but which one resonates with you as a trader? Think about your trading. Which trades have you taken that you feel most comfortable with and have worked best? Do more of those. But regardless, make your trading process your whole world. It's all about a process. It's all about following the process. That is my advice. Okay, let's head back over and take a look at the trades that I have for next week. I have some on the daily, I have some on the weekly, but I always like to point out at this point in the podcast that here I have 11 potential setups for next week. Now, it's possible next week all 11 of these could trigger. Does that mean I'm going to take all 11 trades? 100% no. I only take one trade per day. Even if I have 5 great ones, I'm going to narrow the 5 down to 1. And how do I do that? I give each trade a quality score. For example, if it has one entry signal, maybe I give it a score of 1. If it has 2 entry signals, I give it a score of 2. If it has 3, I give it a score of 3. Well, if I have a score of 1, 2, and 3, I'm probably going to take the one that's 3. However, you also have to look at the risk to reward ratio. Maybe the one that has 3 signals has a bad risk to reward ratio. Okay, maybe you got to take some points off for that, right? I also look at higher time frames. If I'm trading on the daily, I like to look at the weekly to see whether or not there's some potential support or a signal on the weekly time frame. I like to look at relative strength. Maybe the market's down, but on this particular day, one of your candidates is up. It gets an extra bonus point because it has relative strength to the upside. So, you know, this is what I try to teach my students. It's extremely important. And by the way, I do teach private one-on-one lessons in the evening time. I teach people all over the world, and I teach a 20-hour course. It's a long course. We're going to spend a lot of time together, right? And it's one-on-one. I think the best way to learn anything is one-on-one. You can ask a lot of questions. And what I like about having the 10 weeks is that we spend 10 weeks and we see a lot of different market environments. So in my course, I teach you all the different trading approaches that I use. We go over all the rules. When we're done with that course, I want to make sure that I've turned out a great trader, and I have turned out a lot of great traders over the years. So the course does cost $2,000. Yes, it's an investment, but it's an investment in a real skill that you will be able to use the rest of your life. So if you're interested, just reach out to me. My email is in the link of this YouTube video. I like to have an initial call with a prospective student. It's not a sales call, I promise you. I just want to get to meet with you, understand your trading goals, your challenges, and it's a good time for you to also ask me questions about the course. But I love to teach. Like I said, I teach people all over the world, and it's very important to me that when they're done with the course, that they're great traders. So if you're interested, send me an email and we can start the process. And I'd be really happy to have you as a student, and I'll teach you everything that I know. One more thing, if you like online courses, I have a really good online course available at udemy.com. It's the Deep Dip by Stock Trading Strategy. It's very affordable. It's somewhere between $30 and $50, but you get 9.5 hours of video. It's a great course. It took me like 6 months to record that course, but I have sold so many of those around the world, and I got such high ratings on that. So if I can help you either with the one-on-one course or, again, the video course is the link is the Udemy courses. The link's in the description, and my email's in the description as well if you're interested in the one-on-one course. So anyway, that's the business side of the podcast, and let's get on to the potential trades for next week, shall we? First on deck is AMD. Okay, I have been kind of stalking and watching AMD for a long time. I had a great trade on AMD. You can see back here in January 12th, rejection of the high of the order block and rejection of the 100-day moving average. Look at that trade. That was a great trade. I got out here. Well, now we are back to that original order block or that smart money area. The key level that I'm looking for on AMD next week is a rejection of 196.80. Why 196.80? Let's go back over here. You see the 3 bars? These are a V2. Bar 1, bar 2, bar 3. 2 goes under bar 1's low. 3 closes above bar 1's close. Where's the support level? Halfway the washout bar, 196.80. You can see when it came back, that's right where it bounced. We're pretty close to that right now. So next week, if we get another rejection of 196.80, and the way that it closes, it gives me a good risk to reward ratio, I would potentially take that. My stop would be 196.80 if I'm wrong. Alternatively, it closed below the bottom of the order block. Looks like that's 194.03. So next week, if we came down under 194.03 and then closed back in the bottom of the order block, that of course would be legitimate entry as well. So either 194.03 rejection bottom of the order block, or a rejection of the halfway of the V2 washout bar at 196.80. So that's what I'm looking for on AMD. Alibaba. Okay, so Alibaba is interesting. We have an order block from the past. And again, here's the order block. Here we change market structure. When you look up here and then you look back here, was smart money buying there? Yeah, clearly it was. Clearly. Well, we're back to that smart money area. But this time we have closed back below it. But we're at a key level right now. We're at a key level. We're below the 200-week moving average, and we did close below the low of the order block. So what I'm looking for next week would be a close back into the order block. And if that happens, we will also have rejected the 200-week moving average. Now, we have earnings coming up here on the 5th. So, look, if this happens, if the signal closing back above the 200, if this happens right before earnings, a day or two, I probably won't take the trade. But if after earnings happens, we reject this level, then I would consider taking the trade. So we're at a key level. We have lost the 200. We have lost the bottom of the order block, which is bearish. But if this happens on Monday, yes, I would probably take the trade, but I would have to get out before earnings, right? Because I never hold through earnings. But if it continues down and then after earnings, it closes back above the 200 or back into the order block, I would consider taking the trade there. Salesforce, CRM. Okay, so we had a recent market structure change. Let's take a look. Swing low, swing high, lower swing low, market structure change, defines the order block. What level am I looking for? I'm looking at two different levels right here. I'm looking for a rejection of 182.10. Why did I pick that? Well, one, it's the top of the order block, and two, it's about halfway at this big up bar right here. So that is one level, 182.10. If it rejects that and gives me a good risk to reward ratio, I would consider taking it. I would also use the 182.10 as my stop. Alternatively, 178.60 would be another level inside the order block that I'm interested in. Why? Again, we have a V2 here. Halfway the V2 is the 178. If it rejected that with a good risk to reward ratio, I would consider it. And then alternatively, if we reject the bottom of the order block, the low of the order block is 174.57. So I'm looking at three levels. I'm looking at a rejection of 182.10. I'm looking for a rejection of 178.60, or I'm looking for a rejection of 174.57, exactly, which is the bottom of the order block. The Dow, DIA. All right, this one's pretty good. I like this one, and it may get there. Look, we have an order block here from 1231. Bring that order block into the future. Look at the big up bar here. Remember, big up bar's halfway, going to be some inherent support. That's why I drew the line here at 481.50. In addition to that, we have the 100-day moving average as well, kind of dovetailing very close to that 481.50 level. Now, we're a ways away from that right now. I don't know if it's going to get there. But if it does get there, I want to be prepared, have my levels marked so that I don't have to think about it in real time. I can go, oh, that was my level that I was looking for. That's what I'm taking. So three levels that I'm looking for on DIA. Rejection of 481.50, that would be my stop. A rejection of the 100-day moving average, which at the moment is 481.12. Or a rejection of the bottom of the order block, and the bottom of the order block, the low is 480.36. So we'll see if that happens. And if it does, looks like a pretty good high probability setup, although it could fail too, right? But I have to identify the levels to begin with. Etsy. Okay, so I talk a lot about bullish order blocks, but we also have bearish order blocks. And at the moment, we have a bearish order block. Swing high, swing low, higher swing high, market structure to change to the downside. Let's look at it this way. Here, we change market structure to the downside. So as we continue down and we look back up here to the bearish order block, was smart money buying here? No, clearly smart money was not buying there. It was the opposite of smart money. So therefore, if we get back into the opposite of smart money area, I may want to look for a short. And that's exactly what I'm looking for right now. So at the moment, actually, I could have taken a short trade on this on Friday. I did not. But really what I'm looking for would be a rejection of the high of this bearish order block, 58.09. So in other words, in the future, if we come up, reject the high of that order block and close back below it, I would take a short position there. My stop would be a close back below the high of the order block of 58.09. So I'm looking for a short here if we reject the high of this red box. And again, that high is 58.09. Goldman Sachs. Oof. Man, look at that. Ugly, ugly day on Friday. Well, what I'm looking for, I don't know if it's going to get there. And see, that's the thing. I don't know. I don't care if it gets there. All I do is look at this chart and go, for some reason, if it got there, that would be the spot. And if it doesn't get there, I'll move on to a different trade. But if it does get there, I've already determined that's the spot I like. And it makes a lot of sense. For one, we have a 200-day moving average. That alone, rejection of the 200-day moving average would be legitimate. Right now it's at 778.63. But you can see this 200-day moving average is living inside this order block. So two primary signals. Now, the 200 is a little bit above the order block, but essentially it's right there. So this is a smart money area. Again, if we look up here, when it was at 987 and we look back to where the order block formed at 755, can I say smart money was buying here? Well, yeah, clearly. If people were buying here and it went up here, that was smart money. Well, I'm waiting for it to get back to that level, and it may get there. And if it does, the spot that I would be looking for initially would be a rejection of the 200-day moving average. And then I would use that as my stop. Alternatively, if it continues down or rejects the bottom of the order block is 750.28. That would also be a legitimate entry. Meta. All right, Meta. Meta is an interesting spot. Look at these two bars here. These two bars are called a island reversal. An island reversal is similar to an abandoned baby, like I showed you on silver, but an island reversal uses two or more bars. We gapped down, we had a sideways bar, and then we gapped up. It left these two by themselves. Well, when the high of an abandoned baby or the high of an order block, a high of an abandoned island reversal is a key level of support. That high is 618. So I bring that 618 into the future. If we were to reject the 618 level, meaning we went below it and then closed back above it, that would be a rejection of the high of the island reversal. If that happens, I would consider taking the trade. The way that I would take this trade is similar with what I do with abandoned babies. If that happens, I would put a 2 ATR stop and a 4 ATR profit target, and one of those two we're going to hit. But that's what I'm looking for. 618 rejection of 618. If that happens, I'll consider 2 ATR stop, 4 ATR profit target. NVDA, man, look at this, what's happened over the last few days. Just brutal. But we are getting into an important level. We have the 200-day moving average, deep dip buy moving average inside the bullish order block. So that's a key level. So this one's pretty simple. I'll be looking for a rejection of the 200-day moving average. At the moment, it's 174.95. So next week, if we reject the 200-day moving average, I would consider taking the trade as long as it gives me a good risk to reward ratio on a closing basis. And then a close back below the 200 would be my initial stop. TMC, the metals group, very interesting. We're in an interesting location here. Again, 200-day moving average inside the bullish order block. It closed below the 200. Next week, if we close back above it, that would be a rejection of the 200 and a rejection of the top of the order block. I would consider taking that as well, using the 200 as my stop below. Tesla, well, I've been talking about Tesla for weeks. It has not gotten where I wanted to get to, but you know what? It's getting pretty close. Bullish order block back here from 1121. Key level here, 339. Why? Halfway of the washout bar, the V2. That's an important level. Alternatively, we have the 200-day moving average that's in that same general area. In addition to that, we have a megaphone trend line, swing low, lower swing low, bring it into the future. You see how the megaphone trend line is literally kissing the 200-day moving average as well? In this area, there's likely to be a lot of support for multiple reasons. The 393 level that I mentioned, the 200-day moving average that I mentioned, and the trend line. So different things that I can key off of. I can't predict what's going to happen, but I'll know it when I see it. But again, the potentials, rejection of 393 or rejection of the 200-day moving average or rejection of the trend line. But if those happen, they'll happen together. But that's what I'm looking for on Tesla. That could be a good trade. Could also be horrible. But there are a lot of confluences of signals here. And again, I did not get into Tesla. I saw the levels that I wanted. They just haven't got there yet, but they're getting close. Walmart. Walmart is a bearish order block. And again, why is this a bearish order block? It's the opposite of a bullish order block. Swing high, swing low, higher swing high. Market structure change. Was smart money buying up here when ultimately we got here? No. Was the opposite of smart money. So if it gets back to the opposite of smart money, I may be looking for a short. So what I'm looking for on Walmart would be, at the moment, I'm looking at two levels. A rejection of the high of the order block, 134.65, or a rejection of 131.40. Why did I mark that? Look at the big down bar. Big down bar. If we have a big down bar, where's resistance? Halfway of the big down bar. So if we go up and reject 131.40, I would consider getting short here, and my stop would be a close back above 131.40. Alternatively, if we reject the high of the order block at 134.65, I would consider getting short there as well. So those are the dailies, and then let's look at the weeklies. I have one on weekly, and it is Microsoft. Now, Microsoft has really been beat up. Obviously, look at this. This is horrible, especially for a stock like Microsoft. But a very, very key level on the weekly is coming up here. That's the 200-week moving average inside this previous bullish order block, 370.67. Next week, if we do bounce at the 200 or go under it during the week and then close above it, that would be a rejection of the 200 week and a very, very low oversold level. Doesn't mean it's going to work, but it just means that it's an important key level of support. And if the market rejects it and tells me it doesn't like anything under 200, I would consider getting long here. So there you go. Those are the dailies, and this is the weekly. I hope that was helpful for you, for something to take a look at next week, so you can get an idea of what I'm looking at and the process. If this was helpful today, anything in the podcast, really, I would appreciate if you could hit the thumbs up button. Like I said, it really helps out with YouTube, and I appreciate it a lot. If you could subscribe, that would be great as well. So I hope you have a good rest of your weekend, everybody, and you get some time to relax. And if I can help you with anything, like I said, I teach the 20-hour course. It's a great course. I'm sure you'll love it, and you'll be glad that you took it. Just reach out to me, help you with that. Online course is available, udemy.com, the link's there. I also do private consulting. If I can help you with that at all, anything I can help you with your trading, just contact me. We will work something out. But I love to help people with trading. I love to help, or I love to teach people. and watch them succeed as traders. So I always like to leave off with, please try to go out and do something nice for somebody, every day if you can. If you have the opportunity, why not, right? This world needs some good things happening. And if you can do one act of kindness every day, just would help make the world a better place. If you have the opportunity and you have it in your heart and you can help an animal one day, or have given act of kindness to an animal, they appreciate acts of kindness just like we do. So I always like to, use my little platform to at least mention that before I leave. So if you have any comments or questions about anything I covered today, please put them in the comment section. I'll do my best to get back to you. But again, enjoy your weekend. And God willing, I will see you next week. But thanks a lot, everybody, for your time and for coming today. Hope you found it helpful. Thanks so much, everybody. Take care. We'll see you. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.